everyone. Good evening. 5 p.m. on the clock. It's time to kickstart Rise with India Prime Time, and we do so as always with the Money Show, your one-stop destination for all your personal finance-related questions, whether it's with respect to investing or spending your money wisely. Well, here's what we have lined up today on TMS. First up, news reports are suggesting that SEBI may be tightening debt mutual fund norms. More precisely speaking, they want mutual funds to value any securities that are due for maturity under 30 days as per mark to market. Now, I know I've used a lot of jargons, but we are going to simplify that to make all our debt mutual fund holders and liquid mutual fund holders understand what exactly that means. Also on the show, we are going to be decoding all the goodies that FM Nirmala Sitharaman has given us, especially from the realty front. But I'm going to get an understanding more from a customer point of view. And also, if you're a home buyer or a home seller, what is in store for you? And finally, in our Meet Your Fund Manager segment, we are going to bring on board Mr. S. Krishnakumar of Sundaram Mutual Fund to talk about his fund. All of this is lined up on today's edition of The Money Show. But before we kickstart the show, here's a quick look at the headlines. Q1 FY20 GDP at 5% came as a surprise for RBI, says Governor Shakti Kanta Das. Speaking exclusively to ET Now, the governor says almost every central bank has followed RBI and changed the stance to accommodative. Das also adds that the slowdown needs both counter-cyclical measures and structural reforms for economic revival. RBI is working on how to regulate NBFCs better, but won't influence any lending decision of banks, says the central bank governor. Shakti Kanta Das also says that mega PSU banks merger announced recently will improve governance and enhance reach of larger banks. Oil prices soar to a 4-month high. Brent surges almost 15%, clocking its biggest single-day advance after a drone attack forces Saudi Arabia to slash output by half. Meanwhile, back home, the Petroleum Ministry is closely monitoring the situation, even as Aramco assures of no supply shortage. A wobbly start to the week on the Lal Street as oil spikes sparks renewed selling. OMC is back the biggest loser, but the Nifty manages to end just above 11,000. But the rupee depreciates the most in 13 days. HDFC's KK Mistry hails the measures announced by the government to boost affordable housing, says last mile funding will help the projects which are stuck. But global brokerage firm CLSA is unimpressed, says measures may not move the needle much for economic revival. Okay, those were the top headlines at this hour. But like I said, we are going to take on board topic one. That is with respect to debt and liquid mutual funds. It's still, of course, a draft order being mulled, but it could become reality very soon. And when I was introducing it, I know I used a lot of jargons, but we are going to simplify all of these jargons. And I think the person who I'm going to bring on board is best at simplifying jargons. Feroz Aziz, Deputy CEO of Anand Rathi Private Wealth. Hi, Feroz. Pleasure having you with us, as always, on The Money Show. What we are looking at now is basically SEBI almost every 2-3 months coming out, tightening norms a little by little, you could say, for the mutual fund industry. And now the latest is that they want that debt mutual funds essentially mark to market all securities that they own under 30 days maturity. So what exactly does that mean for our viewers out there who are holding these debt mutual funds?
Yeah, I think point one is, like you said, the regulation is changing bit by bit. I think it's very good from an industry standpoint that it doesn't happen whole hog. It needs to be staggered so that people are acclimatizing themselves to the changes and all of it is not given once. Point two, when it comes to specifically this rule of mark to market, like you said, it's very important for a viewer to interpret what does this nomenclature actually signify. Mark to market is nothing but a term to describe that if you have a paper or a bond you can either value it at face value or you can value it at market value, like mark to market. Whenever there are bonds which are 1 month to maturity, asset management companies were permitted to keep it at face value. Let's assume there is a bond of 2 lakh rupees. The AMC, when computing the net asset value of the fund, would consider it as 2 lakh rupees in the erstwhile regime. Now, the AMC is actually ordered to compute the market value of that. If it is 2 lakh 1,000, 1 lakh 99,000, whatever is the actual traded price has to be used to compute the NAV. This phenomena of using market price is called mark to market. If you use the face value, it's non-mark to market. Gradually, most of the bonds were mark to market. But there were bonds which are just 30 days to maturity were permitted to be valued at the face value, not the market value. Now that rule changes from April 1st, 2020. Coming to what is the impact? Largely this impact will be for liquid funds, because 45% of the total assets under management under this category of liquid fund, which is a whopping 2.5 lakh crores, is into less than 30 days paper. So this is the actual transmission of this. Liquid funds will actually have a change in the methodology of computation of its NAV.
The NAV. So just to again very simply put it, suppose I have a liquid fund paper that I'm holding and I want to redeem it, say, tomorrow. So as opposed to what goes on right now where I get the value of the NAV, if I am redeeming it tomorrow, then I would essentially have my papers that the liquid fund is holding, the value would be different. But now with this rule coming in, I would know every day what the NAV is that right?
So the NAV gets computed using hypothetical face value of the bond. Now it will change to, after April 2020, it will change to the actual market value. So what does this imply to an investor? It implies that the net asset value movement is going to be marginally more. Because in the erstwhile regime, it was constant. 2 lakhs, 2 lakhs, 2 lakhs on a consecutive day. Now it's going to be 2 lakh 1,000, it's going to be 2 lakh 500, 2 lakh 1,500. So there is going to be a marginal shift in the volatility. That's the movement in the NAV of a liquid fund. But that's going to be marginal. So that's not going to change the life of a retail investor or even an HNI investor. Who will get impacted would be the large corporates who put a few hundred crores in liquid funds over weekends. Put the money on a Friday, take it back on a Tuesday, for example. So those guys are definitely going to be impacted, and the hot money which comes into liquid fund will be a little more careful going forward.
So what about debt mutual funds? I mean, is there going to be a bigger impact in liquid funds and not so much so in debt? Because that's more common for retail investors.
Correct. Now, if I put things in perspective, most debt funds, now if you look at money market funds, have 4% of their bonds currently held in that category. So 96% is anyways mark to market, so 4% is going to change. In the rest of the categories, you have ultra short term, which has 7%, and low duration, which has only 2% of their bonds, whom this rule is going to be extrapolated to. So it's the extent of the bonds you hold where this rule is applicable will determine the actual impact on the NAV of that specific category.
Okay, all right. Well, yeah, like you said, most of our investors out there, or at least the liquid funds is mostly owned by corporates who park their money, over the weekend or whatever. But nowadays, of course, liquid funds is getting very popular even among investors, and it's so easy, right? One click of the button and you have your money just transferred into a liquid fund. So all the more it was important to understand. So if I have to compare the current regime versus what SEBI is proposing or what's going to kick in with effect from the 1st of April, which one would be better? Because I would assume if you're marking to market, if a verb can be possible out of MTM, if you're marking to market, there would be more transparency, right, as to what my actual NAV is?
So I think mark to market is the best method, because every investor gets the risk and the reward what he or she deserves. If you don't mark to market, one person's reward or risk can be transmitted to somebody else, which is not a good practice, which is not a good transmission of the risk return which a fund is supposed to get. So what is right to do is mark to market each paper, because it's only a little clerical effort or a logistical effort on behalf of the AMC to make sure that the second decimal risk reward to specific investors is transmitted in the proportion which they've actually taken.
taken okay, got it. All right. Okay, on that note, I'm just going to invite all our viewers out there to send in any questions or queries that they may be having on this topic, on, the portfolio that they have currently. And of course, Feroz Aziz will help you answer that. This is our Ask the Money Show segment. The number is 24990388. You can call in over there and we will get your questions and queries answered. But before we do that, let's just take some questions that we have received for now via email. And our very first question is basically on essentially a portfolio that someone has, and he does say, Mr. R.V. Rao, he writes to us saying that I've been investing in equity mutual funds via SIP right from 2011. He has an investment already of around 62.5 lakh rupees, and that's turned into 71 lakh rupees. Well, good for you, Mr. Rao. And of course, his question is that he is a long-term investor, but his question is it desirable to continue investment and keep the corpus untouched in the face of the impending slowdown, or move it to a safer fund like a debt fund or a fixed deposit till the dust settles down? It's a question I'm sure you've as well been asked very often, that, oh, there's a slowdown, so should I now, decrease my SIP or redeem my funds and move it to, these so-called safe havens like FD or gold? So how would you advise Mr. Rao?
So I would say, of course, the markets have been choppy. Point one is, any investor, most investors actually don't like uncertainty. But the good part is, uncertainty is what creates return. If you wait till all the uncertainty is over, be rest assured the return would already be made and you would be coming at the fag end of making the return, just like a retail investor ends up doing. And that's the flaw of actually coming in the last leg of the return movement. So don't be worried about uncertainty. Uncertainty is the reason why equities deliver twice more than a fixed deposit, point one. Point two, Mr. Rao, don't use timing of the market as your risk mitigant. Use asset allocation as your risk mitigant. Having monies in debt, having monies in equity. Now, if you have 62 lakhs invested, which has transformed itself to 70 lakhs, it's important to have a certain portion of that money in debt funds as well, so that there is a plan A to the portfolio, there's a plan B to the portfolio. If the markets don't do well, at least the debt funds chip in with certain degree of stability to the portfolio. So that's my advice number two. Advice number three is continue investing, because all the damage which was supposed to be happening on the broader markets has happened over the last 1 or 2 years. Of course, the Nifty has held up on the back of about 6-7 heavy weights in it, but the broader market has already gone through a carnage. A large portion of the stocks are already at their 52-week lows, in fact 18-month lows. So I don't see too much pain left, and I think you've taken most of the pain. Don't get out, and bounce backs will keep you out of the market forever, and that's happened to several investors when they've tried to get out of the market thinking it's further going to fall. They've been out of the market for years when the bounce backs have happened. So I would certainly use asset allocation to mitigate my risk rather than timing.
All right. And yeah, you're a long-term investor, so you really don't have to time the market in any manner. And you've already seen the fruits of being a patient investor, 62 lakh to 71 lakhs. Since we're talking about debt funds, Feroz, I just have a follow-up question, because this is a question we get very often on email as well. And that is, looking at the way yields are moving, looking at the way interest rates are moving. I mean, the governor as well said that, we're looking at a 5% GDP, which means there is a possibility that we may see repo rate being cut again, which basically means that interest rates in the country will go lower from here on. So in such a situation, is a debt fund good to hold?
I think a debt fund is good to hold. Debt funds, whenever you buy debt funds, there are two kinds of risks you take. You have to be very cognizant of the fact that there are two separate risks. One is the interest rate risk, like you mentioned, Mubina. When interest rates go down, debt funds get a gain out of the fall in the interest rate in a different quantum, depending on how that debt fund is placed. The other risk which you take when you buy a debt fund, when you're lending your money, which is in effect the case when you're buying a debt fund, is a credit risk, where you lend your money and the company goes bankrupt or insolvent and does not have the capability to return your money. So these are the two risks. I think taking an interest rate risk, even at this stage, I think from a long-term perspective will not pay off, because the interest rates on a 10-year government paper has come down significantly. So point one I'm making is be very aware of the two risks, interest rate risk and credit risk. Point two, further rate cuts are possible. So use a accrual fund, a corporate debt fund. I think making 8-9% over the next 3 years is still a likelihood, because corporate papers are giving far more than the government paper. So you can capitalize on this higher interest which companies of India are giving. I think corporate debt fund would be my pick.
And we've been seeing also a lot of issues. Tata Capital, Shrey, all of them had come out with a lot of NCDs. So yeah, point taken. Also, credit risk, I think, is more scary nowadays. We've been reading a lot in the papers about how certain companies are not being able to repay, CPs, etc. So you've got to be wary of that as well. Okay, we have Samir, who's joining us from Mumbai on the phone line. Hi, Samir. Thank you for calling in. What's your query?
Yeah, hi. I wanted to know, I wanted to invest in debt funds. So, what are the best debt funds I can invest in? And I'm new to, I am more interested in investing in debt funds compared to fixed deposits. Usually, I keep my money in fixed deposits.
Okay.
So, what are the benefits if I invest in debt funds compared to fixed deposits? Thank you.
You've not invested in any other kind of equity. Okay, that was very crisp. Before I could ask him a follow-up question, he's disconnected. Okay, so basically, if you heard out his question, he just basically wants to know that just like a lot of investors out there, he's been investing in fixed deposits, but he's new to debt mutual fund investing. So essentially wants to understand the difference between the two. And of course, if you could recommend some good debt funds, he could start off with.
So I think in the debt fund category, if he's beginning, he can buy the Franklin Templeton Dynamic Accrual Fund or a Franklin India Short-Term Fund. These two funds will actually have some degree of credit risk, but it's very well managed by Santosh Kamath.
Yeah.
I think it's very well diversified credit risk, has the potential to give you 8.5–9% over the next 3 years. I think that would be my recommendation. From a second part of his question, what's the difference between a fixed deposit and a debt fund? To my mind, a fixed deposit is going to be lower on rate, point one, because getting a fixed deposit today for 3 years would give you about 7%, 7.25% at maximum, depending on the quantums you're ready to put in. But the second point is there is a tax efficiency possible because fixed deposits give you interest income, which gets added to your marginal tax rate. But debt funds give you capital gain under Section 73. Capital gain has a tax of 20% after 3 years, and you get an indexation benefit. So the tax arbitrage for people who are in the highest tax slab is the maximum. And I think so if you have a tax arbitrage and a higher return, you can almost on a post-tax basis make 3% more. I think that's the benefit, Samir.
So just to explain once again for our viewers, what essentially Feroz was trying to say is, let's say if you want 1 lakh rupees in your fixed deposit as fixed deposit interest, that'll get added to your total income. And if let's say your total income without interest was at 7 lakh rupees, it'll inch you up to that 8 lakh rupee bracket. So you'll end up paying more tax. That is not the case with debt mutual funds. So I hope, Samir, we've been able to help answer your question. As Feroz said, 8–9% in the Franklin debt fund, as opposed to just 7% that you may get in a fixed deposit, and it may go only lower now because the RBI is cutting rates and banks have to pass it on. So obviously they'll as well cut fixed deposit rates. So you've got to be a bit cautious about that. Of course, I wish you good luck as well as you kickstart your investing journey. Let's take on board our next question. We have Sarvajit Guleria, who has sent in a query, and he has sent us his portfolio of roughly 3 funds, all of them from the same AMC. There's the ICICI Large and Mid Cap, the Blue Chip, and the Balanced Advantage Fund, and that's it. And he wants to know that if he has to redeem one of them and invest it in the equity markets, which one should he redeem? So firstly, Feroz, is it a good idea to have, all your money is parked in one AMC, or would you advise distributing it around?
No, it's of course, Mubina, as you rightly caught the point from his portfolio construct standpoint, having all of them from one asset management company when you have 42 of them needs to have a very strong reason why you have all 3 there. And I'm sure there's no case to be built where you can have all the 3 at once. Most often than not, when I meet people and when you see that there are all funds from one AMC, it's generally the banker being constant with the AMC. That's why generally people end up buying the same AMC. So I think you should liquidate 1 or 2, in fact 2 of them, and the Balanced Advantage Fund you can definitely move to a Invesco Growth Opportunities Fund, and then you have an ICICI for approved Blue Chip, which you can move to Mirai Asset Large Cap Fund. So you'll have 3 different AMCs trying to work for you with different strategies, different capabilities across market capitalization to help you achieve your goal. So don't have it in one AMC, and remember this as a rule. If your banker is only recommending one AMC product, you should probably make sure that you diversify your risk across different baskets.
And we in the Money Show always there, of course, to help you out choose those individual funds. So consider redeeming 1 or 2 of them. And of course, Feroz has shared his list as well, which he believes could be lucrative money-making options, to invest in. So pull it out from 2 of them and put it, of course, in the list that Feroz has given. Okay, we have Mr. Japesh from New Delhi who's calling us. Hi, Japesh. Good evening. What's your query?
Hello. Good evening to both of you.
Good evening.
I had a specific query. Given this new development that is today's topic,
Yeah.
that you are looking at a changeover to the MTM regime from next April.
Yeah.
Now, I have a particular investment in a liquid fund.
Okay.
I would like to know from the expert that what kind of implications would it have? Supposing I had planned that I would redeem my liquid fund only in December 2020. Now, because of this changeover, do you think there would be a lot of convulsions in my fund, say next March? And would you advise that I make a clean break from this investment and get out of it and maybe look at a reinvestment sometimes later? What would be your advice?
All right. Feroz, I'll let you take that.
Yeah, Mr. Japesh, I think I don't think you have anything to worry about. When you're speaking about 30 days papers or 30 days bonds which are embedded in your liquid fund, this will actually maximum have an impact up to 30 days. So I don't see this as a dramatic change for an investor who has bought liquid funds, not just from a 3, 4, 5-day perspective, but you still have a holding period expected of a year and a quarter. So you have nothing to worry about. This change is only going to be a benefit to you, and that's going to be insignificant, neither a benefit nor significant benefit, nor a loss for you. Your periods are far, far more than a 30-day period. It's largely directed towards the corporates who use this as a platform for a very short-term parking. So nothing to worry at all. Just stay the course. Whatever your purpose of redeeming the money at a point in time exists. So just stick to that, and I don't think you can actually ignore this part from your perspective, especially for having used it for a year and a quarter as a liquid fund platform.
All right, Japesh, I hope you're rest assured now with this answer. And of course, be patient as always when it comes to investing in the markets, in equity mutual funds especially. Of course, you have a liquid fund, but I hope Feroz has answered your question. Okay, next up we have Durga, who has written in to us. Now, Durga is a fairly young investor. He says, I'm 25, investing in around 5 funds, Kotak Standard Multi-Cap. There's also the Kotak Emerging Equity. There's a Parag Parekh Long-Term Equity, HDFC Small Cap, and ICICI Nifty Next. It's anywhere between 5 to 6,000 that he is investing in each of these funds. His goal is wealth creation, and he has a very fixed CAGR of around 12 to 15% that he wants to earn. I think quite reasonable, really. But if you had to give a quick perusal to the selection between the, the capitalization that he has chosen, what would you recommend?
So I'd recommend 3 changes. Parag Parekh Equity needs to move to Kotak Standard Multi-Cap. Okay. And you have to move HDFC Small Cap to L&T Mid Cap. And the last one, which you need a change for, where you've bought an index fund, which is a Nifty 50 index. To my mind, Nifty 50 index fund has done better over the last 2 years vis-a-vis an active managed fund. But I am of a very strong opinion that's going to change going forward because the broader market was doing badly. So Nifty index funds were doing well. So move your Nifty index funds, especially for a long-term investor. Extra return which the fund manager will be able to generate with the intellect which he brings to table is going to be there. So I will look at Reliance Large Cap, which is now Reliance Nippon Large Cap kind of a fund to bring in extra 2% return. I think you're, like Mubina, you mentioned, the expectation of 12 to 15 over the long run is not an unfair expectation, especially having taken the equity risk. And I think it will pay off if patience is something as an attribute you can have as an investor.
Must have, actually, isn't it? Not can have, must have that as an attribute, honestly. Okay, I was going to actually ask you one more question on composition, but before that, let me just bring on board our next caller, Mr. N.D. Savla from Mumbai. Good evening, Mr. Savla. What's your query?
My question is, can a public charitable trust invest in equity mutual fund or any mutual fund?
Okay, a public charitable trust. Feroz, will you be able to help him out?
Yes, so it's very important to understand that a charitable trust, which gets several tax exemptions to be classified as a charitable trust, has a specific list of mutual funds which they're permitted to invest in. So it's important for you to interpret that list and make a choice within the list of funds which are approved. But there are a large list of funds which are there for the open market, for your personal investments for that matter, 1,000, 2,000, even 3,000, including the closed-ended funds which we have as an industry. But out of the 457 equity mutual funds which are in the open-ended category, there are a fewer list which you will have to go through and make a choice from that narrow subset which is allowed for charitable organizations.
All right, Mr. Savla, I hope Feroz has answered your question. On that note, we're out of time on this edition of Ask the Money Show. So, Feroz, as always, thank you so much for joining us and helping our viewers understand that new norm that has come by for debt mutual funds, for liquid mutual funds more specifically, because that's where you're going to see a major part of the impact. And of course, it's mostly corporates actually that park their money in liquid funds. Not that it's of course restricted to investors, individual investors, pardon me, because straight up, if you look at a simple comparison, in fact, that's a tip I'd give all our viewers out there. Today, your savings account gives around a 4% interest rate. Yes, there are some banks who've come out and said that, hey, we offer you around 6%, but a majority of our banks offer a 4% interest rate. Put that money in a liquid fund and you'll straight away get 2 percentage points extra. So why not? And of course, with digital banking coming to the fore, it's as simple as a click of your fingers. You can invest today, redeem it 2 days later, or even tomorrow for that matter. Hence, liquid funds can give you some more return potential compared to a savings account. Of course, we do have these new norms, but like Feroz said, you don't really need to lose your sleep over that. Okay, we will do one thing. We'll take a quick break right here on The Money Show, but when we return, we are going to be decoding FM Nirmala Sitharaman's norms on The Money Show, and of course, we're also going to be bringing on board our Meet Your Fund Manager segment. Hi everyone, welcome back. You're watching The Money Show on ET Now. We told you all about debt mutual funds, liquid mutual funds, the new norms that SEBI is talking about when it comes to marking to market, and what's going to be the impact for all of you. Well, now let's move away from debt and liquid to equity mutual funds. We're going to talk today to the manager of the Sundaram Diversified Equity Fund. The fund, as the name suggests, belongs to the Sundaram Mutual Fund House and is managed by Mr. Krishna Kumar. But before we do that, let's bring on board Karanya Rao for a quick snapshot of how the fund has done and, of course, what are the key constituents of the Sundaram Diversified Equity Fund. Karanya.
Today in our Meet Your Fund Manager segment, we will be diving deep into Sundaram Diversified Equity Fund. This is the CAGR it has delivered over the last 1 year, 8.4%. For 3 years, 5.1% CAGR, and 5 years, it has delivered a CAGR of 9.4% in terms of returns. Let's take a look at the sectoral composition as well. Where is it that it has, banks with nearly 22% exposure, there's finance, nearly 16% exposure there, there's consumer durable 10.2%, software 9%, lastly there's cement with 5.5% exposure. This is what the pie looks like when it comes to the sectoral spread for Sundaram Diversified Equity Fund. Let's also talk about the top 10 holdings. Interestingly, 7 out of 10 names are all heavyweight. So if you look at it, top holding is ICICI Bank with nearly 7% stake. There's HDFC Bank 5.7%, Bajaj Finance 4.6%. Over and above that, there are names like an L&T, which also features in there it is, L&T 4.4%, which features in the top 5 names. There's Axis Bank 4.3%, there's Reliance Industries as well at 4.1%. Next up, there's a broader name, a name from the broader index as well, which is featuring on their list finally. There's Aramco Cements, where they've invested 3.2%, SBI 2.6%, another heavyweight there. There's Varun Beverages 2.6% is what they're invested, and lastly there's an SBI Life Insurance as well with 2.5% exposure. So this is exactly what the top 10 holdings look like, and the sectoral composition and the returns they've generated over time.
All right, Karanya, thanks a lot for that. Well, that of course is a Sundaram Diversified Equity. You took a quick look at what the constituents are, and now of course for all our unit holders out there, for that matter all our viewers who may be interested in investing in the fund, On the Meet Your Fund Manager segment, as the name suggests, we are going to meet the fund manager of the Sundaram Equity Diversified Fund. So let me bring on board Mr. S. Krishnakumar, the Head of Equity with Equity Sundaram Mutual Fund. Mr. Krishnakumar, thank you for joining us on the Money Show for our Meet Your Fund Manager segment. Let's start off first with the basic theme. It's an ELSS essentially also, folks, you need to remember that. So for this ELSS, what's your investment strategy, the style, what's the basic theme, when you're managing the fund?
Sundaram Diversified Equity Fund is our flagship ELSS fund. It has a track record of over 20 years and it's been one of the oldest products that Sundaram offers. Here, the investment philosophy has been to generate long-term wealth for investors by focusing on companies which have potential to deliver sustainable growth over the medium term. The market cap positioning of the fund has been multi-cap in a sense that we typically invest between 50 to 70% in the large cap space and about 30 to 50% in the mid and small cap space. Depending upon growth, valuations relatively, we would kind of try to move between large cap overweights to higher allocations to mid and small caps. This has been successfully done over the last 20 years to generate alpha for the investors. The philosophy continues to be buying growth at a reasonable price. We look at 3 to 5 year perspective when we look at growth, and valuations are looked at in perspective of a growth outlook of 3 to 5 years in terms of earnings. So what could appear expensive on the near 1 to 2 years could appear actually very reasonably priced if one has a 5-year view. And this is what we have practiced here to be able to get in early into stocks, growth stocks, and hold them through the growth trajectory. So this approach has been able to generate significant alpha in the last 20 years.
All right. Mr. Krishnakumar, how do you allocate monies between large and mid-cap names then for the fund?
We look at a broadly steady-state allocation of about 60 to 40, 60% in large caps and about 40% in mid caps. This gets tweaked by about 10 to 15%, depending upon the relative returns offered by the large caps or the mid caps and the valuations basically. So we do have internal yardsticks in terms of measuring valuations and the differential valuation between large and mid caps, which we kind of use to shift between the market cap buckets. Further, I think more than just the large and mid cap allocation, I think it's all about identifying a basket of high growth opportunities across large, mid and small cap spaces and nurturing them across a 3 to 5 year horizon. For example, a small cap company which could be having a market cap of less than $1 billion is something that we kind of populate the portfolio and allows the stocks to kind of go through a 3-year to 5-year kind of a growth cycle, and we remain patient with those kind of stocks. Whereas from a large cap perspective, there are considerations vis-a-vis the benchmark where you do have top 15 stocks which are quite heavy on the benchmark. We try to take a fundamental view in terms of what we like and don't like, and that conviction provides the portfolio heavyweights at this point in time. Further, I think the rest of the portfolio of about 60% is populated with more bottom-up ideas which will deliver against the benchmark that we have.
Since I've asked you that question, Mr. Krishna Kumar, I must ask you about the SEBI recategorization norms as well, because that is something that mutual fund representatives have been sort of complaining about, saying that it makes it a little tough to operate in such a restricted environment about those recategorization norms. So, Mr. Krishna Kumar, do you have any such complaints? Do you believe it's becoming a little tough to operate the fund because of those categorization norms?
I think there has been no major impact on the tax-saving ELS schemes. I think that category remains to be what it is, and there is enough freedom for the fund managers to operate, their portfolio strategies at this point in time.
All right. Okay, that's good to know. Mr. Krishna Kumar, now for our viewers, I mean, all of us, of course, who want to invest in the Sundaram Diversified Equity Fund, what sort of return expectations should they have? What should be the risk appetite? And also, what sort of time horizon should the fund holder have before they consider investing in the Sundaram Diversified Equity Fund?
In terms of the tax savers, typically, they are logged in for 3 years. So, we would believe that the portfolio that we do construct has a lot of bias towards selecting names with a 3 to 5 year perspective, as I explained to you. So we would believe that on a longer term basis and over a 3-year period, which is the investment horizon, investors should ideally look to have a 15 to 20% CAGR in returns.
All right. And finally, Mr. Krishna Kumar, before we wrap it up, just to summarize our entire conversation, please do send across and leave a message behind for all your current unit holders as well as prospective unit holders who may be listening in right now.
I think, the tax saving category is something which locks an investor in for 3 years, which is a very good horizon to have from equity investing. So the probability of making losses is that much reduced. Further, these tax savers give you also a dividend yield across the period, which will further help you to kind of book profits in a way and take some of the profits out, which could be reinvested again for better benefits. So I think tax saver is a very sound investment proposition, which also boosts return by the tax benefit that you have. Further, I think equity as an asset class is one of the best asset classes from a return perspective over the medium term, and the tax saver is centrally positioned there. So I think a great product for entry-level investors, and for even risk-averse investors. I think this is one way where the tax shelter kind of boosts your return to a better level and gives you a good experience in investing.
All right, Mr. Krishna Kumar, thank you then for joining us on The Money Show and on our Meet Your Fund Manager segment to talk to all our viewers out there. That, of course, is the Sundaram Diversified Equity Fund. It's an ELSS scheme, which means to get the tax benefits, you will have to be invested for at least 3 years. So if you have a lesser time horizon, and by the way, if you do have a lesser time horizon, equity funds should not be also on your radar. But yeah, anyway, if you do have a lesser time horizon, you will not get the tax benefits. Okay, on that note, we'll take a very quick break right here on the show. But when we return, we are going to be talking about the new bag of goodies that FM Sitharaman has unleashed on Saturday. This time around, it's a booster shot for the housing sector. So whether you're a real estate buyer or a seller, let's see what she has in store for you right after this break. Hi everyone, welcome back. You're watching The Money Show on ET. Now we are going to take on board a topic that everyone's been talking about over the weekend. FM Nirmala Sitharaman doled out a festive gift, if you could call it, prior to Diwali. Whether or not it's apt is what we will be discussing today. But yes, it is a booster shot for the housing sector. It is something that is going to, aid all the buyers out there, especially in the affordable and the mid segment. So, Is it something that will help you? Because not all projects are going to get this leg up from the government. So let's discuss this and more with Prashant Thakur. He's the head of research with Anurag Property Consultants. Prashant, thank you for joining us on The Money Show. My first question, the FM announcements. How much of a festive gift is this as you would celebrate, Prashant? And I know we are talking only about the mid segment and the affordable housing segment, but do you think this is a good Diwali gift that the finance minister has given home buyers?
See, the stage at which real estate is right now, I think any step would be, a welcome step. So what was announced on 14th by Honorable Finance Minister is a welcome move. It's still debatable that whether this was sufficient or not. So if we look at the three broad announcements that she has done, the most prominent was of setting up a stressed fund asset of 10,000 crores. Whereas additional 10,000 would come from other entities. So the total 20,000 crores of the stress fund would help those projects which are not in NCLT and not NPA project. And as you rightly said, that the projects under affordable and budget segment would qualify. So it has certain clear indication that government still wants to kind of encourage affordable housing and to a certain extent budget housing. We are yet to see what is the definition of budget housing that the ministry has to define. We have a clear-cut definition for affordable, which is 45 lakhs and below. So, and this, the benefit of the stress fund will go to those projects where the construction has been 60% completed. So, one clear thing for the home buyers to cheer is that people who have already bought flats in projects which are stuck because of last mile funding have some reasons to cheer, because they will see their project get moving, and they would get some hope that their project will get completed and they will soon have the possession. So this is a good move to a certain extent. Now whether this is sufficient or not, it's kind of I would say more was expected out of the announcement, because the major pain is in those projects which are completely stalled. So as of now, close to 1,74,000 units are stalled projects across 7 cities of India, where more than 65% of the project is already sold. So there are generally home buyers whose money is stuck, and this fund and the announcement that was made exclude such kind of projects. So it's kind of a missed opportunity where few of the buyers, or I would say largely most of the buyers would feel the pinch. But again, having said that, the projects which are in the last mile of funding would see some traction. So again, if you look at the demand side, this announcement does provides a lot of aid. But the problem that this real estate sector is facing now is more from the demand side. So supply side would benefit from this announcement of stress fund, where you will see some kind of stuck projects moving in.
Right.
But this is not going to boost the demand. So we needed some kind of announcement which would encourage the buyers to come back into the market and start purchasing.
True. Okay. Prashant, you know what? Let me just come in over there. You mentioned that, if you're in the affordable housing segment or in the mid segment. Now, we know affordable is if you bought a house under 45 odd lakh. Mid segment has not yet been defined, like you mentioned. So suppose if I have bought an affordable home, that's the valuation is under 45 lakh rupees, but it has been stuck for whatever reason. I mean, the builder's absconding or whatever it is. Does this announcement mean that I will get, or does this announcement mean essentially that I should see my project being completed in the fairly near future, or are there riders over there as well? Because I know you mentioned one rider, and that is 60% completion. So what are the conditions over there then?
So the other two riders are that the project should not be under NPA category, and it should not be under NCLT. So three broad category is number one, 60% construction should have happened. The project should not be under NPA category, and it should not be under NCLT. If your project, affordable project, is not under these three things, I think the buyer will benefit.
The luxury segment, I mean, are there any goodies that are doled out, or for now it's only for the affordable and the mid segment?
No, I think through various announcements, I think government has clearly set the tone that they want affordable housing and budget housing to flourish. And to be very honest, that's where the market is. That's where the sweet spot is. Today, any project which is in the range of 40 to 80 lakhs, they sell like hotcake. The problem lies in the high ticket projects, 1.5 CR and above. And if they are stuck, I think the buyers of such projects will have to wait for further resolution.
Metro cities like Mumbai, Bangalore, Delhi, that's what you're going to see, right? I mean, projects above 80 or projects above 1 CR. So I think that's a situation that's particularly troublesome. Go ahead. Yeah, Prashant.
Yeah. So ideally, though these announcements that were made by FM is quite a welcome move, but if the definition of affordable housing segment from 45 lakh, if the announcement would have been made to increase the limit to, let's say, 85 to 1 CR, I think that would have been a real booster, where a lot of benefit of affordable housing benefits in terms of additional 1.5 lakhs of interest exemption in the tax could be availed. And you would have seen a lot of buyers flocking the market during this festive season, especially Diwali season. But I think we fell short of that. But ideally, that should have really given a push to the demand. If the definition would have increased from let's say the cap on affordable housing should have been increased from 45 lakhs to at least 80 lakhs. That would have been a real booster for the housing sector.
That's almost double. I think many people are calling this as well, insufficient, and you're asking for double. I think that's still a lot. I suppose the government as well will be able to dole out. But Prashant, see, there are like, I think
if you look at
go ahead, Prashant.
No, what I was trying to highlight is that if you look at the ticket size of 45 lakhs, which has been capped for affordable housing, and if you consider a city like Mumbai, you will hardly find any affordable housing projects. And then, the benefit, basically it will find no takers. So I think the definition should be city specific. For cities like MMR, Mumbai, it should be, on the higher side. But for cities like Hyderabad, Pune, I think 45 lakhs to 55 or 60 lakhs would suffice for affordable housing projects. So I think the government needs to relook at the cap that they have defined for affordable housing. And once that cap is increased a bit, you will see many projects coming into that ambit, and there are actually buyers for these ticket size. So as I said earlier, that any project in the range of 40 to 80 lakhs is kind of performing quite well, and we need to create or let's say we need to enable the buyers who are willing to buy in these price tickets, and that can be only done by increasing the scope and definition of affordable housing.
So what you're also suggesting is that based on whether you're a city or a tier 1 town or a tier 2 town, maybe you could be flexible with the cap of affordable housing. I think that's what you are proposing could be it. Because I agree, in a city like Mumbai, there are hardly any units that will actually be labeled affordable housing, frankly. Even the Mahada units nowadays, of course, do cost more than 40 odd lakh rupees. So really, these are the times that we are living in. But Prashant, what I wanted to ask you was that we have more than 5.5 lakh units that are stuck or delayed in, I think, the top 6-7 cities itself. This fund that, the government has proposed is around 10,000 crore rupees. I mean, is this going to be enough really? Can all our buyers out there who have their projects stuck expect that, I mean, I'm going to see now my building be completed or whatever after waiting for so many years? Because do you think basically that our buyers out there have full reason to celebrate?
No, I would not say that the buyers have full reason to celebrate, but I think, this gives a signal that this government is willing to look at the problems in a phased way. So I think this was the first step. And the finance minister has been quite clear that she would revisit such topics as and when required. So in my opinion, this first move is something, the buyers should be hopeful that the problem would be at least heard in a proper way. If you look at the way the stuck projects in NCR, likes of Amrapali and other Supertex are being handled, by bringing in NBCC, I think the government is trying, sincerely trying to resolve the crisis. We have to wait for, how this fund pans out on the ground. I think the government will also look at the outcome of this 20,000 CR fund that they are kind of proposing. How does that helps the sector? And I think they would take the call in the phased way. So I will not say that the buyers have, all the reasons to cheer, but I think it should give them a sense of relief that at least there's a government who's kind of willing to look into the matters seriously.
That's the case. If we do have a government that's willing to look into the matter, and if prices are so rock bottom, and when there's so much inventory as well in almost every city, then as a Diwali purchase, as usually is the norm for a lot of Indians who do want to invest a little bit of their money in property ahead of Diwali or on Diwali, would you recommend then that property in India is a good time? It's a good time to buy in right now?
See, I've been saying quite often and regularly that this is the best time for a buyer who is looking to buy a flat for his end use. For example, if I want to buy a house for my self-consumption, I don't think anyone would get so many options of ready-to-move-in inventory where the prices have not gone up in 5 or 6 years. The prices are at least quite low. Your home loans have come down. So I think if you're looking for a purchase for your own use, this is the best time, and I would encourage people to buy. So for investor, it's it has to be a long haul, but for end user, for self-consumption, I think this is the best time to buy.
Time to buy, especially if you want to buy a house for yourself. On that note, Prashant, thanks so much for joining us and breaking down all the FM announcements.
Yeah.
Unfortunately for luxury property owners, and when I say luxury, I'm talking about perhaps those homeowners who have bought a house more than 80 lakh rupees. Not much in store, but hey, if you bought a property under 45 lakhs or maybe under 80 lakhs, there still may be something in store for you. Okay, on that note, we'll wrap it up on this edition of The Money Show. Thanks so much for watching. But before we let you go, here's a quick sneak peek as to what's lined up for you ahead in Startup Central.
Naivety is fantastic because if you know about all the hundreds of problems, now imagine if you want to get into financial services today, you'd say that, hey, look at NBFC, so many problems and so on and so forth. But a true entrepreneur who's naive but truly excited about making a difference will tell that, well, maybe I can figure out.